Hi everyone, my name is Mario Echevarria. I'm a senior wealth advisor here at SRP, and I'm joined here with Bob Wagner, our chief investment officer. And we just want to give you a quick update on the third quarter as well as our outlook going forward for 2022. So really at a high level, 2022 compared to 2021 has just been night and day. You look at what's happening in the market, really, there hasn't been any place to hide. Things like domestic equities are down roughly 24% as of 9/30. Overseas or international down roughly 27. And then the big shocker here, which we'll dive more into, is the bond market, which has been told is the safe place for money. I mean, that was down almost 15% for the quarter. So when you look at 2021 to 2022, again, it's just a night and day, and we'll dive into why this is happening. Anything you want to add, Bob?
No, it's just this is one of those rare years where diversification did not work.
So really, why is that? And these are the key things that we're looking at. And really the three things. It's the first one is this thing called inflation, which many of you have seen at the grocery store, you've seen at the gas pump, you've seen it just in your wallets. So we'll talk more about what inflation is, why it's popping up the way it is, but it's mainly driven by three factors here. The first one, supply chain issues that we've witnessed over the last 2 years. Things like energy, which we'll dive more into macro thing. And then also things like wages and labor, which play into the cost of goods and services. Also, the next thing which some of you may experience is things like title financial conditions. So when you look at yourself as a consumer, this is looking at things like borrowing money for a mortgage or looking at your savings accounts. So we've been in this environment where money's been very cheap for very long. And now to try to stop inflation, making money more expensive to borrow has hurt the consumer as well as the economy. And then last, there are things that are really out of our control, these macroeconomic factors. So we're having this election in terms of the midterms, but then the bigger things are what's going on overseas in Europe and Asia. So when you have a war between Russia and Ukraine, which impacts supply chain as well as energy, the next bottleneck is what's happening over in China and Asia too. So Bob, why don't you talk through just kind of inflation, why it's been popping up recently, and just what are we seeing on the wealth side?
Okay, as you can see on this left side chart there, inflation has been building quite a bit. Recently, it peaked out around 9.1%. Now, when we look at inflation, we look at the components of the CPI as being sticky or transitory. Right now, what's going on is the Fed is raising rates to slow down the economy, try to get fewer dollars chasing the fewer goods. The problem is the situation we're in now is the Fed is trying to fight a supply side problem with demand side tools. Now, what does that mean? We're having supply side shocks. We have the war stopping fertilizer, food, energy. We have lockdowns in China. There's all sorts of things that are taking supply off the market. The problem is the only tool the Fed has is to raise interest rates. And what does that do? That stops demand, right? Well, we don't really necessarily want to stop demand for food and energy. That's how you drive an economy. And so the problem they're facing now is they have forces that are driving inflation higher, keeping inflation higher for longer, but they don't really have the tools to address that. And that's the big problem that they're facing right now in the markets. Now, if you look down the components of the CPI there, if you raise interest rates, you might slow down recreation buying, housing buying, education buying, but you're not going to solve the real problem that's out there, and that's the food and energy. And so that's the real conundrum that we're in right now. And it remains to be seen how this is going to get resolved. And the reason that's so important is inflation is pretty much the cornerstone for everything. Inflation will drive interest rates, which equities and bonds are valued off of. So depending on how they work out the inflation issue, pretty much will translate into where the economy and the markets go.
Yeah, I think that's a good segue into one of the things that we look at in the investment committee. It's this thing called the yield curve, which what the yield curve does, it measures debt of an economy in both short-term and long-term. So honestly, the bond market tells you way more about an economy than the stock market does. And what the yield curve shows is what is various debt paying across time. So we have debt that matures in 1 month, so very short-term. You have debt that's looked at intermediate term, so this is mainly the index, so anywhere from 5 to 7 years of maturity. Then you have debt that's out 10 years, which most mortgages are tied to the 10-year note, and then very long-term debt, 30 years out. And over time, this blue line here shows you what was the debt market paying as of last year, 12/31. And honestly, this has been what we've been used to for the last decade, if not longer, where money's been very cheap to borrow, which means that you incentivize growth and you incentivize investment, which promotes growth, obviously. So to Bob's point, when you have a lot of money flowing in the system, the big thing that pops up is inflation. So one of the ways that you try to reduce inflation is you make it more expensive to borrow, which is why you see a massive shift in our yield curve in literally just 11 months. So this is unprecedented how fast this has happened, which is why you're seeing a shock across the bond market as well as the stock market too. It's a big change over a short period of time to try to reduce the amount of inflation going on.
Yeah, and remember that as interest rates rise, bond prices fall, all else held equal. So that's kind of a good graphic there to demonstrate what I mean by this was basically a no places to hide market. Across that entire yield curve, bonds got hit. One interesting thing to look at here, though, is if you see how the front part of the yield curve over to the left, it's upward sloping. After the 1 year, it's downward sloping. Typically what we watch for is what's called an inversion in the yield curve to give us a clue on what the markets are thinking going forward. So that inversion of the yield curve is often a harbinger to a recession, or B, it's starting to signal that you may be near the peak of the interest rate cycle, which will be a good thing.
Exactly. So what we're saying now is an inversion here, and that's really leads into the next point. It's what clients are asking us, well, what are the key takeaways from this quarter and looking forward? And what we're saying is brace yourself for volatility. Rates are still going to be going up into the new year, and then you hear these talks of recession. And even so, there's still war going on overseas. So volatility will be here to stay. The next thing is inflation. Even though it's going down slightly, it's still going to be relatively high compared to history. So learning to live with it is going to be a daily occurrence for all of us. And then lastly, when it comes to the portfolios, it's looking at things that like fundamentals, where investments matter again. So looking at companies or type of sectors where cash flow is positive, have stronger balance sheets. On the bond side, looking at things that can keep up with inflation versus traditional bonds. So just a lot of shifts in terms of your portfolio and what fundamentals are.
Yeah, and one additional note there is, things may seem a little doom and gloomy right now, but there are a couple of what I call green shoots. One, markets tend to do well after inflation peaks. They tend to do well after interest rates peak, and they tend to do well in a second half of a presidential cycle after a midterm. So there are some green shoots forming. There's talk about a recession, but often the markets will look beyond the bad news and start to discount better news once you get through it. They often say that the markets tend to rally in the third inning versus when before the economy bottoms. So there are some bright spots, but there are some challenges that remain.
Well, I know we talked through a lot here, Bob, and I appreciate your time. And if anybody on this call has any questions about your portfolio or just the general economy, please feel free to reach out to your local wealth advisor or just the WELLth team. Happy to have a conversation one-on-one. But I hope you all have a good holiday with your families and look forward to talking to you in the new year. Thank you.
Thanks, everybody.